Adrian Movat, in fact, told us in the morning itself, which really stood out to me, that, India's results season has been a tad disappointing. Hence, we might see some consolidation. In fact, talking about numbers, I think we can go across to the Tata Steel management. They reported a good set of Q1 FY24 numbers from its India operations, but Europe business continues to struggle a little bit. Nigel Dsouza caught up with the MD and CEO of Tata Steel, began by asking him about the quarter gone by and the outlook on the EBITDA from its India business. Listen in.
The numbers need to be adjusted by about 2,000 rupees if you take off the one-off. So we'll roughly be around 14,000 rupees per ton EBITDA for India.
All right, so 14,000 rupees per ton. Now, in the last quarter, realizations were a saving grace, actually, because you'll have auto contracts that were revised. There will be better product mix as well. So my question to you is, both in Europe as well as in India, if I compare the average realizations for quarter two, how do they compare with quarter one? How much lower are they?
So, Nigel, just now, the sense we have is Q2 will be about 3,100 rupees per ton lower than Q1 in India, and maybe about 35 to 40 euros per ton lower in Europe compared to Q1.
Okay, all right, fair number out there. But the booster shot is going to be that, yes, realizations will fall, but the cost of coking coal, that as well will come down. So again, a two-part question out here. For the past quarter, that's a quarter gone by, how much higher will coking coal cost? And for the coming quarter, how much will they be lower?
So, Nigel, I will talk in terms of consumption because that's what hits the bottom line.
Yeah.
So last quarter, the consumption cost of coking coal was about $10 higher, which is what we had guided, both in Europe and India. Europe was a bit less, India was a bit more, but broadly around $10 per ton higher consumption cost in Q1 compared to Q4. But you will see Q2, because most of the coal that we bought in Q1 was at a much lower price. In Q2, you will see an improvement of at least $50 per ton, both for Europe and India in coking coal costs.
So in that sense, then, Mr. Narendran, how does the EBITDA per ton shape up? Will it be better in the coming quarter in comparison to the quarter gone by, both for India as well as Europe?
So if you look at it from a spread point of view, it's obviously going to be similar or slightly better. But I think there are costs beyond coal and iron ore and the steel price, and those are the costs that we are watching. So largely we're looking at, on an underlying basis, can the EBITDA per ton be similar in both Europe and India, and then look at how to manage other costs better.
What's the way ahead for Europe, Mr. Narendran? Because the street is very, very worried about that. You're having talks with the UK government. Have you all heard from them? Are they going to be giving in some support? Or is the parent of Tata Steel looking at infusing some money? Because Europe is clearly struggling.
Yeah, so Nigel, I think we need to look at Europe again as Netherlands and UK separately. We've got bad numbers in Europe also because we have a blast furnace relining going on in Netherlands. So basically, Netherlands, which has two blast furnaces, is today operating with one blast furnace. And a blast furnace relining typically is a 5 to 6 month kind of job. So that's going on. And that's why we had also guided that Q1 and Q2 will be challenging quarters for us because this blast furnace relining had been planned and is going on. As far as UK is concerned, obviously, when steel prices are not great and spreads are not great, the business is always under pressure, which is what we've seen again. There are conversations going on with the government. I think the conversations have been progressing. It had slowed down a bit, but again, it's picked up pace. We hope to try and find a solution which works for all of us, for them, for us, and for our employees there. So let's give it some more time. But I think we feel that we are coming closer to a solution.
But how much more time, Mr. Narendran? Because that business is struggling. You have a few options on the table. I'm going to put some out to you. Will you consider shutting down those units completely if the talks don't work out or if they're taking too much time? Or are you looking at maybe trying to find a buyer yet again for this unit?
So, Nigel, all options are hypothetical. All options have their costs. So I think in the past, we've looked at all options and we know pretty much what the cost of each option is and what the consequences of each option are. So I think the best solution if we can find is the one where the government supports us into a transition into a greener steelmaking process route. And of course, we need to then discuss with the unions and everybody else to make sure that everyone is on board. So it's obviously a fairly complex process that we've been running with. Yes, it's taken time because there have also been different governments that we've been talking to in the last 2-3 years in the UK. But now I think we're making some good tangible progress. And like I said, we hope we'll come to some sort of conclusions in the next few months.
Have you all reached out but to scout for a buyer?
You know, honestly, we've tried it in the past, right? It's not that people are queuing up to buy the UK asset. But of course, there are parts of the UK assets which always there are people interested. We'll come to that stage when we need to exercise that option. But I don't think we are there yet.
How much more money do you need to put into UK though? UK cannot, it's not able to support itself. So the India operations or other parts of the group will have to support the UK entity. So
we did support it last year as well to some extent. And I think obviously the objective is to minimize the support rather, in fact, if we can eliminate it, nothing like it. We didn't support it 2 years back when they were doing well. And obviously, we're trying to see how to minimize the support. The teams there are continuing to do a lot of good work and take out a lot of costs. And that's helping us reduce the support that is required. But obviously, it's a business which has always fluctuated between a minus 200, 250 million EBITDA negative to a plus 100 or 200 million EBITDA negative. So that's a range in which it's been operating for the last few years.
How much money do you need to spend but out there? Ballpark, rough number, capex for UK operations?
No, I wouldn't want to give you a number just now.
Okay, let's focus on the debt number then. The debt number has gone up by 3,500 crores because of capex of 4,100 crores. So two numbers. What is the capex you have planned for this year, and is that on track? And what about the debt reduction? You know, the street seems to be in the vicinity of 4,000 crores to 6,000 crores in terms of a debt reduction. What should that reduction target be for this year?
Sure. So firstly, yes, the capex plan was about 16,000 crores for the year. We stick by that. And Q1 has been roughly 4,000 crores, as you said. So we are on track for that. Most of the spend is actually going to Kalinganagar for the completion of the project. Already the cold rolling mill and the pellet plant have started. So we will be commissioning the balance facilities, over the next 12 months or so. The blast furnace should start by February or March. And steel melt shops, one of the casters, will start later this year. So a lot of commissioning work is going on. So the capex is as per plan. As far as debt reduction is concerned, like we said for the last 3-4 years, our target every year is $1 billion reduction at least. Last year we couldn't do it, but the previous 2 years we well exceeded our target. This year has been more challenging than we thought because we had started the year thinking that China will do better than what has transpired. So the steel prices have been weaker than we thought. So let's see where it goes, but we stay committed to that goal. And let's see, we have the second half of the year. We expect things to be better because we expect some recovery out of China. We expect our second blast furnace to come back online in Netherlands. So we expect a much better H2 than H1.
Well, it'll be a tall ask if you can do that $1 billion odd. But as you said, the target is to reduce it. Let's see how much you do. Final question before we let you go. The India piece is still looking good, and India seems to be having momentum. So are you looking at some inorganic growth? Have you submitted a bid for NMDC Steel? The last time we chatted, you said you didn't. So have you submitted it in this interim? And also Vedanta Steel, they are looking at selling that steel asset, or they're looking at, doing something with that asset, and they could probably look at selling it as well. Will you all be interested?
So Nigel, when we, earlier looked at Electro Steel before Vedanta acquired it, we did not have with us Usha Martin and Neelachal. So now we have both Neelachal and Usha Martin, and in Neelachal we can build a 10 million ton long products complex. So we are well positioned to grow in long products without having to acquire any new assets. And NMDC, like I said, we were not really keen on it because again, between Kalinganagar and Bhushan, we can add another 15 million tons at least in both these facilities, because Kalinganagar alone will add another 12-13 million tons over the next few years. And the Bhushan plant can add another 5 million. So about 17-18 million tons of flat products can be added in our existing footprint. So we don't need to start another site just yet.
So you're not looking at inorganic growth in India?
I think organic growth is what allows us to pace ourselves better. And brownfield expansion tends to get cheaper simply because you're better utilizing infrastructure that you've already built.
Okay, that's the word coming in from Tata Steel. Big mover, they're up almost about 3% post a good set of numbers. Let's take a short break. On the other side of the break.